The 1980s were supposed to be Japan's century, the moment when a small island nation with virtually no natural resources would eclipse the United States as the world's dominant economic superpower. And for a brief, intoxicating period, this seemed not just possible, but inevitable. Japanese companies were buying up American landmarks like Rockefeller Center and Pebble Beach. Japanese banks were the largest in the world. Japanese manufacturers were humiliating their American competitors, and the Nikkei stock index was soaring to heights that made Wall Street look pedestrian. Tokyo real estate became so expensive that the grounds of the Imperial Palace were theoretically worth more than all the real estate in California, and American bookstores were filled with titles predicting Japanese dominance and urging America to learn from Japan's superior methods. But this wasn't the story of a rising superpower gradually accumulating influence over decades. It was a bubble of almost incomprehensible magnitude, built on systemic distortions and policy errors that would lead to a lost decade of stagnation, then another lost decade, and now what some economists call a lost generation. And to understand how Japan went from buying the world to losing everything in such a short span, we need to go back to the Plaza Accord of 1985, which set in motion a chain of events that would reshape global economics and destroy trillions of dollars in wealth. The story really begins in the early 1980s when the American dollar was extraordinarily strong, in part due to Federal Reserve Chairman Paul Volcker's brutal interest rate increases designed to crush inflation. This strong dollar made American exports expensive and Japanese exports cheap, contributing to massive trade imbalances. Japanese cars and electronics were flooding into America, while American products struggled to compete in global markets. American politicians and manufacturers were screaming about unfair competition, and pressure was building for either protectionist measures or some kind of coordinated international response. So in September 1985, finance ministers from the United States, Japan, West Germany, France, and the United Kingdom met at the Plaza Hotel in New York and agreed to coordinate intervention in currency markets to drive down the value of the dollar. It seemed like elegant diplomacy, a way to rebalance trade without resorting to tariffs or trade wars. But what nobody fully anticipated was how dramatically the yen would appreciate and how Japan would respond to that appreciation in ways that created the most spectacular asset bubble in modern history. The yen rose from about 240 to the dollar in early 1985 to around 150 by 1987, nearly a 40% appreciation in just 2 years. This should have devastated Japanese exporters by making their products much more expensive in foreign markets. And indeed, many Japanese companies struggled, but the Bank of Japan, terrified of recession and pressured by politicians to maintain growth, responded by slashing interest rates and flooding the economy with money. The discount rate fell from 5% in 1985 to just 2.5% by 1987, the lowest in Japanese history at that time. And this cheap money had to go somewhere. Japanese companies, which had been manufacturing powerhouses focused on exports and long-term market share, suddenly found themselves sitting on enormous piles of cash in an environment where borrowing was essentially free. And rather than investing all this capital in productive capacity or returning it to shareholders, they began speculating in real estate and stocks, creating a feedback loop that would spiral completely out of control. The mechanism was elegant in its perversity. Companies would borrow cheaply, buy land. As the land appreciated, they could use it as collateral to borrow even more, then use that borrowed money to buy more land or invest in stocks. And because everyone was doing this, asset prices kept rising, validating the strategy and encouraging more speculation. Japanese accounting rules allowed companies to value their landholdings at historical cost on their main balance sheets, but recognized the appreciated value when calculating net worth for borrowing purposes. So companies could appear conservatively managed while actually being leveraged to the hilt based on inflated asset values. And banks were happy to lend because real estate was considered the safest collateral imaginable. After all, land prices in Japan had never fallen, not since records began. There was even a saying, land prices never go down. And this belief was backed by what seemed like solid logic. Japan is a small, mountainous country with very limited usable land and a large wealthy population. So of course land would always appreciate. It was a fundamental truth, a law of nature. Questioning it marked you as someone who didn't understand Japanese uniqueness. The stock market followed a similar trajectory for similar reasons. The Nikkei 225 index stood at around 13,000 in 1985. By the end of 1989, it had nearly tripled to 38,915, an ascent so steep and sustained that it made the American bull market of the 1980s look modest. And this wasn't driven by corresponding growth in corporate earnings or productivity. It was driven by speculation, by companies investing their cheap, borrowed money in stocks, by banks buying shares in their client companies as part of the Keiretsu system of cross-shareholding, by insurance companies and pension funds piling in because everything was going up, by individual investors mortgaging their homes to day trade stocks. And remarkably, this was all considered normal and rational. Financial analysts would explain that Japanese stocks deserved higher price-to-earnings ratios than American stocks because Japanese companies focused on market share rather than short-term profits, because Japanese management was superior, because lifetime employment created more stable workforces, because the Keiretsu system provided advantages that Western companies lacked. Every reason why Japanese stocks should be worth less was somehow twisted into a reason why they should be worth more. It was rationalization masquerading as analysis. The real estate bubble was even more extreme than the stock bubble. At the peak in 1990, the total value of Japanese real estate was estimated at around $20 trillion, roughly 4 times the value of all real estate in the United States, despite Japan having half the population and a tiny fraction of the land area. The grounds of the Imperial Palace in central Tokyo, about 1.15 square kilometers, were said to be worth more than all of California or all of Canada, depending on which estimate you believed. Luxury apartments in Tokyo sold for millions of dollars for spaces barely larger than American walk-in closets. And the insanity wasn't limited to Tokyo. Property prices in Osaka, Nagoya, and other major cities rose almost as dramatically. Golf club memberships, which came with land rights, traded like securities and reached astronomical prices. The membership at Kagane Country Club near Tokyo peaked at 500 million yen, about $4 million at the exchange rates of the time. To join a golf club, not to buy it, just to become a member, and people paid these prices because they believed they could sell later at even higher prices, because land never goes down, because this time was different, because Japan was different. Japanese companies and investors, flush with capital from appreciated assets and cheap borrowing, began a buying spree abroad that alarmed and fascinated the world in equal measure. In 1989, Mitsubishi Estate bought a controlling stake in Rockefeller Center for $1.4 billion, an iconic piece of American real estate in the hands of Japanese investors. Sony bought Columbia Pictures for $3.4 billion plus assumption of $1.6 billion in debt. Matsushita bought MCA/Universal Studios for $6.1 billion. Japanese investors bought the Pebble Beach Golf Course, the Exxon building in Manhattan, and trophy properties across America, Europe, and Asia. Japanese banks dominated global finance. The top 10 banks in the world by assets were all Japanese by 1990. Japanese tourists were famous for buying luxury goods in quantities that astonished retailers. Japanese art collectors set record prices at auctions, paying $82.5 million for Van Gogh's portrait of Dr. Gachet and $78 million for Renoir's Bal du Moulin de la Galette. And American business schools were teaching Japanese management techniques. American politicians were warning that America was losing its competitiveness. Authors were writing books with titles like Japan as Number One and The Coming War with Japan. The zeitgeist had shifted from seeing Japan as a defeated enemy that America had rebuilt to seeing it as an unstoppable rival that might soon dominate the world. But beneath this triumphalist narrative, the contradictions were building. Japanese consumers weren't benefiting from their nation's supposed wealth. Despite all the appreciation in stocks and real estate, ordinary Japanese people worked longer hours for less leisure than their counterparts in other developed nations, lived in smaller homes, paid higher prices for food and consumer goods due to protectionist policies, and saved ferociously because the social safety net was weak. So even as Japan appeared rich on paper, actual living standards were lower than in countries with less impressive GDP numbers. The appreciation in assets was benefiting companies and wealthy investors, but not workers, creating wealth inequality in a nation that prided itself on egalitarianism. and the speculation was distorting the real economy. Companies were making more money from financial engineering than from actually producing goods. Manufacturing was being neglected in favor of Zydeco, financial speculation. Factories were being built not where they made economic sense, but where land was cheap because the real profit was in the land appreciation, not the production. Young people were giving up careers in engineering to become real estate agents or securities traders because that's where the money was. The entire economic structure was being warped by the bubble. The Bank of Japan and the Ministry of Finance watched this spiral with growing concern but seemed paralyzed. Raising interest rates aggressively would pop the bubble, but might also cause a recession and bankrupt highly leveraged companies. Keeping rates low would inflate the bubble further. They tried modest tightening in 1989, raising rates from 2.5% to eventually 6% by 1990. But by then it was too late. The bubble had grown so large that even modest pricking would cause catastrophic deflation, and deflation is exactly what happened. The Nikkei peaked on December 29, 1989, at 38,915. Within a year, it had fallen to around 23,000, a 40% decline, but that was just the beginning. It would eventually fall below 8,000 in 2003, wiping out 80% of its peak value. Trillions of dollars in paper wealth evaporated, and the real estate crash was even more devastating because it destroyed bank balance sheets in ways that the stock crash didn't. When stocks fall, investors lose money, but the financial system can survive. When real estate collapses, and it's been used as collateral for massive loans, banks fail. And that's exactly what started happening. The mechanism of destruction was as elegant as the mechanism of inflation had been. As asset prices fell, companies and individuals who had borrowed against those assets faced margin calls. They had to sell assets to raise cash. But everyone was selling simultaneously, driving prices down further, creating a death spiral. Companies that had seemed healthy because their balance sheets showed appreciated land holdings suddenly looked insolvent when those holdings were marked to market. Banks that had lent freely against real estate collateral suddenly found themselves holding loans worth far more than the underlying assets. And Japanese accounting rules and regulatory forbearance allowed banks to hide the extent of their problems for years. They could continue to carry non-performing loans at face value. They could roll over loans to bankrupt borrowers. They could pretend that land prices would recover and everything would be fine. This wasn't malicious fraud. It was a collective delusion enabled by a system that prioritized social harmony and avoiding embarrassment over acknowledging reality. The concept of face meant that admitting the true scale of losses was almost impossible. Better to extend and pretend, to hope that growth would eventually make the problems manageable. But growth never came. And this is where Japan's story becomes a cautionary tale about how bubbles don't just create temporary disruptions, but can damage an economy's fundamental capacity to grow for decades. The aftermath of the bubble saw companies and households shift from spending and investing to paying down debt. Consumption collapsed, investment collapsed, and no matter how low the Bank of Japan pushed interest rates, eventually to zero and then negative, they couldn't convince people to borrow and spend. This is the famous liquidity trap that Keynes wrote about, when monetary policy becomes impotent because people are so traumatized by debt that they won't borrow even when money is free. Japan tried fiscal stimulus, massive government spending on infrastructure, bridges to nowhere, highways that serve tiny populations. The government debt-to-GDP ratio exploded from around 60% in 1990 to over 200% today, the highest of any developed nation, but even this couldn't generate sustained growth because the private sector was too busy deleveraging, paying down the debts accumulated during the bubble years. The demographic situation made everything worse. Japan's population was aging rapidly. The post-war baby boom generation was retiring. The birth rate had fallen below replacement level, and immigration was essentially forbidden due to cultural attitudes about ethnic homogeneity. So the working-age population began shrinking. Fewer workers meant less economic growth. It also meant that the burden of supporting retirees fell on a smaller base, creating fiscal pressures that made stimulus harder. And the aging population was naturally more conservative, less willing to take risks, more focused on preserving wealth than creating it. So even as the government and central bank tried to encourage risk-taking and investment, the demographic reality was pushing in the opposite direction towards safety and stagnation. The zombie company problem became endemic. Banks that were too weak to foreclose on failing borrowers kept them alive with continuing loans. These zombie companies couldn't grow or invest, but also wouldn't die. They tied up capital and resources that could have been redeployed to more productive uses. They competed with healthy companies, often undercutting prices because they didn't need to earn normal returns, just enough to service their loans. And this zombification spread through entire sectors. Retail, construction, and real estate were particularly affected. And because Japanese culture valued employment stability so highly, there was immense resistance to bankruptcies and restructuring that would have cleared out the deadwood. Politicians couldn't be seen as responsible for unemployment. Executives couldn't be seen as betraying their workers. Banks couldn't be seen as heartless. So instead, everyone pretended that unprofitable businesses were viable and waited for conditions to improve. But conditions couldn't improve while capital was trapped in unproductive uses. The policy response was consistently too little, too late, and often counterproductive. When the Bank of Japan finally got aggressive with quantitative easing in the early 2000s, buying government bonds and other assets to inject money into the economy, it was more than a decade after the bubble burst when fiscal stimulus was tried. It often took the form of wasteful spending on politically connected projects rather than investments that might generate long-term returns. When bank restructuring was finally attempted in the early 2000s, it was partial and incomplete, leaving many problems unresolved, and there was constant tension between the impulse to support growth through loose policy and the fear that this would just create another bubble. So policy would ease, then tighten prematurely when inflation ticked up slightly, then ease again, creating confusion and uncertainty that itself hindered growth. It was a masterclass in how not to respond to a balance sheet recession. The international dimension of Japan's decline mirrored its rise. All those trophy assets bought at the peak had to be sold at losses. Mitsubishi eventually sold its Rockefeller Center stake at a substantial loss. Japanese banks retreated from international markets, their dominance evaporating as quickly as it had appeared. The Japanese companies that had seemed invincible in the 1980s, Sony, Panasonic, Sharp, found themselves overtaken by nimbler competitors, Samsung, and other Korean companies. Ate their lunch in electronics. Apple redefined consumer technology in ways Japanese companies failed to match. Chinese manufacturers undercut them on price, while Taiwan's TSMC dominated semiconductors. The assumption that Japanese management techniques were superior proved false. The Keiretsu system of cross-shareholding and long-term relationships that had been praised as a source of stability became a source of rigidity. Lifetime employment made it hard to adapt to changing conditions. Consensus-based decision-making meant companies moved slowly while competitors sprinted. The very features that Americans had envied in the 1980s turned out to be bugs, not features, when the environment changed. The social and psychological impact of the lost decades can't be overstated. An entire generation of Japanese came of age in stagnation, graduating into an economy with few opportunities, facing a job market that no longer offered lifetime employment, inheriting debt from their parents' speculation without inheriting the assets. Birth rates fell further as young people couldn't afford to marry and have children. Surveys showed increasing pessimism and resignation. The old assumptions that had governed Japanese society, work hard, save diligently, and you'll prosper, had been broken. People had followed the rules and still lost. The social contract was shattered, and unlike after World War II when Japan could rebuild with American help and ride the wave of global growth, there was no external savior this time. No obvious path back to prosperity, just grinding stagnation punctuated by occasional crises. The lesson of Japan's bubble and subsequent decades of stagnation should have been learned by the rest of the world. Asset bubbles built on cheap credit and irrational expectations will inevitably collapse. The collapse will be worse the bigger the bubble and the more systemic the speculation. The aftermath requires aggressive policy response, immediate recognition of losses, restructuring of debts, recapitalization of banks, fiscal and monetary stimulus, and acceptance that some pain is necessary to clean out the system. But instead, the lessons were largely ignored. The United States and Europe went through their own credit bubbles in the 2000s, culminating in the 2008 financial crisis. China is arguably in the middle of an even larger property bubble right now. Each time the same rationalizations appear. This time is different. Our situation is unique. The fundamentals are sound. Prices are justified. And each time the bubble pops, the aftermath brings surprise and recrimination, as if this wasn't entirely predictable. What makes Japan's story particularly tragic is how avoidable it was. At multiple points, different choices could have prevented or mitigated the disaster. If the Plaza Accord had been implemented more gradually, if the Bank of Japan hadn't slashed rates so aggressively, if regulators had reined in speculative lending, if accounting rules had forced honest recognition of losses, if banks had been restructured quickly, if fiscal stimulus had been better targeted, if demographics had been addressed through immigration, any of these interventions might have changed the trajectory. But at each decision point, the choice made was either too timid or too late or actively harmful. And this wasn't because Japanese policymakers were stupid or malicious. They were smart, well-meaning people trapped by ideology, by institutional constraints, by political pressures, by cultural factors that made certain solutions unthinkable. The same factors that constrain policymakers everywhere, which is why Japan's experience is so relevant. It shows how easy it is for intelligent people to make catastrophic mistakes, how bubbles can inflate even when the risks are obvious, how the aftermath can be mismanaged even when the solutions are known. The ultimate irony of Japan's bubble is that it happened to a country that supposedly had superior long-term thinking. Japanese companies were famous for prioritizing long-term market share over short-term profits. Japanese culture valued patience and planning. Japanese education emphasized mathematics and engineering. Yet Japan still inflated and then failed to properly address one of history's largest bubbles. If it could happen there, it can happen anywhere. And it has, repeatedly. The human weaknesses that drove the Japanese bubble: greed, fear of missing out, confirmation bias, groupthink, inability to imagine that good times will end. These are universal, not culturally specific. The institutional weaknesses: captured regulators, banks too big to fail, accounting gimmicks, political unwillingness to impose pain. These exist everywhere. The idea that America or Europe or China is somehow immune because of superior institutions or policies is exactly the kind of thinking that allows bubbles to form. Looking at Japan today, more than 3 decades after the bubble burst, the country has still not fully recovered. GDP per capita has barely budged since 1995. Wages have been stagnant. Deflation has been the norm rather than inflation. Government debt is over 250% of GDP. The population is shrinking. There are encouraging signs recently. Some inflation has returned, some wage growth, some corporate reforms. But whether this represents genuine recovery or just another false dawn remains unclear. What is clear is that Japan paid an enormous price for a decade of speculation. An entire generation sacrificed to pay for the mistakes of their predecessors. Productive capacity wasted, human potential squandered, and the country that was supposed to dominate the 21st century instead became a cautionary tale, a warning about the dangers of asset bubbles, the importance of proper policy response, and the ease with which temporary euphoria can create permanent damage. Japan didn't just buy the world and lose it in 1 decade. It bought into a delusion that would haunt the nation for generations, proving once again that there are no shortcuts to prosperity, no financial engineering that can replace genuine productivity, no amount of speculation that can substitute for creating real value, and that when an entire society convinces itself that the normal rules don't apply, that this time is different, that prices can rise forever, the awakening is always painful and often catastrophic, leaving behind wreckage that takes decades to clear and lessons that are forgotten with depressing regularity as the next generation searches for its own path to easy wealth.